Well, I'm going to welcome Phil Compton. Thank you for coming today. Phil is the Chief Financial Officer for Locomotion, an autonomous trucking company with CMU roots, formerly the CFO of Single Source Property Solutions. Phil has significant financial and operational experience in building the team, infrastructure, and profitability of rapidly expanding companies. He has helped raise over 120 million in venture capital financing, leading to the acquisition of 4 of his former companies. He is also the co-founder and CFO of Malcovery Security, a cybersecurity firm he helped launch in 2012 and sold in 2015, as well as the CFO for Netronome, CoMag, I'm sorry if I mispronounced this, Phil, and WiseWire. Phil began his career with the Big Four public accounting firm of PricewaterhouseCoopers and later joined Black Box Corporation as its first controller. During his 5-year tenure in Black Box, he has heavily involved in planning a leveraged buyout and initial public offering, a successful reorganization under a Chapter 11 bankruptcy filing and various SEC filings. Phil is a certified public accountant and holds a BS in accounting from West Virginia University's Chamber College of Business and Economics, where he served on the board. He is also a guest lecturer at local universities and an advisor within the Pittsburgh startup community. So Phil, I'll let you get started. You're on mute.
Let's make sure we don't mute myself, huh? So thanks a lot, Allison. As Allison said, I think this is the 11th time I've taught this class, so it's into the 6th year. It's hard to believe. And it won't be as good remotely as it is in person, but you know, hey, that's the way it is. And I don't know how the professors and you students are doing it. So hats off to you. I'm impressed you guys can keep this up. But at any rate, let's kind of move on. A little bit about myself. I'm from south of the border. I'm a native West Virginian and a graduate of West Virginia University in accounting. I'm currently the CFO of Locomation, which is an autonomous trucking company. We actually pair a lead truck, and this is on the interstates, on the highway, a lead truck driven by a person, normal, followed by a drone truck eventually that will have no driver in it. So we call it an autonomous convoy. And still small, we're about 20 people when I joined in summer. Now we're up to about 26, but still small. And starting to get a lot of press and some good things are really happening with us. And we just signed our first customer, even though we won't have a product for about 6 more quarters. So a company took a big, chance on us, if you will, to sign up for our technology, but about out in 2022. I'm a CPA, an entrepreneur, an investor. I invested in the company I'm with too, an advisor, real active in the local technology community. I started out in public accounting. So you've all probably heard of PricewaterhouseCoopers. That's one of the big 4 accounting firms. But then I went into industry from there. I was with Black Box, as Allison mentioned, WiseWire, which was a CMU spun out company, CoManage, which was a pretty big newsworthy company in the early 2000s, Netronome, and Malcovery. Malcovery Security was a cybersecurity company I co-founded with 6 other co-founders. So we had 7 co-founders. Believe me, that's way too many. And we sold it in 2015 to a larger player in the space whose CEO also went to CMU. So I'm always around CMU in some way, shape, or form. At Black Box, I went through, took them through an LBO, that's called a leveraged buyout. And that's really similar to what private equity is today. Other parties coming in, loaning money to the company and looking to squeeze out costs from the company and eventually flipping it, if you will. That actually was not a good transaction for us for a number of reasons. And because it wasn't, we attempted to go public soon after that transaction. That go public attempt was not successful. So I actually took them through a very successful bankruptcy, which Sounds like an odd thing to say, but it was good for the company, not so good for the creditors. Um, Again, I've had 4 exits altogether, 2 where I was principally involved. 2 of my other companies were acquired after I'd left them. But WiseWire was a pretty interesting company. It was actually, as I said, a spin out of CMU. It was co-founded by several CMU software and electrical engineers. That company was eventually purchased or acquired by a company whose founder was also a CMU grad. And in fact, the leader of that company that acquired WiseWire, called Lycos, the founder of that company was the teacher, if you will, of the CEO of the acquiree company, WiseWire. So I always joke that would be similar to Dave Mulwiney eventually buying one of your companies. So you can see kind of the irony in that, the humor in that, if you will. I've been involved in, now it's up to $120 million in VC funding, is because I helped bring in about another 12 million at the company I'm at. So now it's up to 120 plus. I've been involved in a lot of bank financing. I help a lot with closing customer deals, in other words, contract negotiations. I'm usually the investor relations guy with the company. The CEOs usually don't want to be that person, so I usually take that role on. I was just in our board meeting on Thursday, so I've probably been in about 105, 110 board meetings, so quite a few. And like I say, have been around the tech community for a while. So what we're going to talk about today is financial modeling. We're going to talk about building your model and the assumptions that you should take and document in building that model. We're going to talk about testing your model some, such that you want to make sure your model behaves in the way that you intended it to behave when you built it, so that investors don't find that out, for example. In other words, they don't find out mistakes you might have made. And at the end, I'm going to go through a brief session that really isn't related to financial modeling, but it's for funding and the cap table review, because if you're starting out or have an early stage company, you'll want to, I'm going to demystify the cap table a little bit for you. So we'll do that at the end. When you're building a financial model, you need to set out some assumptions. And set out a time frame. One is you need to really build out your projections for the first 24 months. That sounds pretty laborious and detail oriented, and it is. But it's good for your own planning purposes. In other words, planning out how many people you're going to hire, who's going to be responsible for different functions in the company, when you might eventually launch your first product or service, when you can recognize the revenue for that product or service, when you get paid for that product and service, and so forth. So 2 years, again, kind of nitpicky detail, but it's something you need to do in the beginning. What are you planning towards when you're building your model? Most likely it's your initial funding round. In fact, because I can't really take too much of a show of hands here, it would be a little bit more difficult online like this. I'm imagining several of you are contemplating joining a company, perhaps contemplating founding a company, or have already founded or joined a company. So I don't know the mix of everyone here. But most likely this is going to be your first model for your first funding round, if you're in this class here. Are you building the company to sell? So might be the thought process of some people. There's a lot of types of companies you can get into now that do tend to have kind of shorter life cycles as independent companies. A company, for an example, might be a company that builds apps. You might not be wanting to build apps for 10 years, but maybe you build a particular app that's attractive to others, or a set of apps, and you want to sell that or get acquired by someone. Or maybe you're starting a fintech company, which is really a red hot subject right now, with the mind that you'll get acquired in 18, 24, 36 months. I would suggest that shorter term focus is, does have some drawbacks to it. In other words, you might blow through cash faster than you would if you were thinking about a more measured long-term approach, for example. Are you building a company to become public? That used to be all the rage in the mid 90s to the mid 2000s, but anymore, that's quite an undertaking. It's extremely expensive. It's extremely disruptive. It's a lot more of a consideration in undertaking that big project than it used to be. Having said that, several of you have probably heard of a SPAC, a special purpose acquisition company, whereby you could actually merge your company, perhaps even a fairly early stage company, with an entity or a shell company that's already public. So those have become all the rage this year. They've been around for about 15 years, but 2020, while it's mostly been the year of the virus, it's been the year of the SPAC as well. And it's just a red hot subject that's cooling off a little bit now, but that's another way to go public that, quite frankly, before January this year, not many people, I never even heard people talk about SPACs 10 months ago. So it's really kind of burst onto the scene. But normally, if we're going to sit in this class here, early stage, we're not thinking about going public yet. What I'd suggest is the best way to plan toward is building a company for the long term and see what happens. Believe me, if you deliver a desirable product or service that is in fact tested and adopted early by one or more customers, is then purchased or used by one or more customers, is then, you're able to upsell to those existing customers. You're able to get those customers to refer you to other customers. You're able to get those customers to renew to subscriptions they might have had. And then you become cash flow and profitable break even. If you achieve all those things and build the company for the long term, believe me, good options will open themselves to you. And that's what most of the companies I've been with is take the long-term approach, build an attractive company, product or service, and good options will come your way. You need to be realistic in your numbers and the time it takes to achieve them. So, of course, I'm a finance guy, so I'm all about the numbers, but I've seen a lot of entrepreneurs kind of build out their models, or, I've seen their slide decks, and they're saying, oh, well, year one, we're going to build their product or refine the service. And then year two, of course, we're going to do 5 million in sales, of course. And then in year three, we're going to do 25 million and then 100 million in year four. That's possible, but not very likely to burst on the scene like that. So you need to be realistic in the time it takes to get that product or service up and running, sell it to customers, and to grow from there. So I'm going to talk about that some more. You'll be viewed as more credible and less risky if you do use discipline and good judgment in your projections, as opposed to, again, we're going to be $100 million company in 3 years. Possible, but not that likely. And I just happened to build you a model, a template that's posted somewhere on the servers at CMU that you're able to use. And we'll actually look at that model some here today. It's not perfect, but it's a good start. So some more assumptions. You need to document the assumptions that you make in building your model, because, let's just say you as the founder or co-founder start working in this model. Maybe you're using the model that I'm going to supply for you. And for the first week or so, you can remember everything you did, every keystroke, all your assumptions. In the first month, you probably still remember most of them, but after 3, 6, 9, 12 months, you're not going to remember what the heck you did. So what you need to do is document, even if in bullet point form, what you assumed in the model. What this also does is tell your audience, let's just say potential investors, that you went through a thoughtful process in developing your numbers. You don't want to send your model to someone with no explanation or background and just say, here's a bunch of worksheets and there's a lot of numbers in there. Good luck. What you want to do is give them kind of a cheat sheet or an introduction to the model that helps them to better understand it and review it more efficiently. In fact, I think, no, I'm going to wait. I'll wait and flip over to the model a little bit later. What type of company are you striving to create? Product, where you actually build something. And if I'm in front of you, I'm usually being more demonstrative. I always kind of point to my phone as like the new product. Are you building a new product? Are you planning to deliver a service? Are you going to be a consulting practice? Are you going to be a manufacturer? Are you going to be a manufacturer, or are you going to buy and resell your product? In other words, you'd be a reseller. You didn't make it, but you're buying it and reselling it. So there's a lot of different considerations as to what kind of company you're going to be. If you're a product company and you're going to manufacture, you're going to need a lot more of a robust costing model than you would if you're going to be, say, a software development firm. And my model mostly takes into account a software company. It doesn't necessarily take into account a manufacturing company. So that's what my model is geared towards. Let's continue here. How are you going to obtain your revenue? So I know it's kind of hard to ask questions. I don't know if people are going to answer me here or not, but let's say you're forming your company pretty soon here, or you just have, so you're kind of launching your company here. So in your first year or two, do you think you should engage partners to help you sell, or should you sell yourself? So in other words, should you sell directly as the early stage team, or should you engage partners? Would anyone care to try to answer that?
Partners.
What was that?
Partners.
Oh, partners. Okay. Yes.
Yeah.
Thanks, Harshal. I can see why you would say that, in that if you're using partners to help you sell, that's more feet on the street, more exposure out in the industry, and you can, hang your hat or use someone else's name and leverage that. What I'd suggest, though, having been through a lot of companies, is that you actually try selling the product or service yourself first. And the reason I say that is, you know your product or service better than anyone else. So who better to talk about the virtues, the benefits, the value of the product or service than the very person or team who developed it? Plus, in selling it yourself, you'll learn about the reasons why customers say yes and why customers say no. You'll learn a lot from customers actually telling you no, because they will say, hey, again, Phil and team, you built a great new product here, a great new phone in this case, but actually we wanted these two features and your product doesn't have that. So you learn from interacting with customers what you might not have gotten right the first time, or in your first iteration or version. You also learn what really resonates or connects you to a customer. After having learned that and conducted a few sales successfully on your own, and again, getting told no quite a bit, you then can turn to partners and educate them with, maybe frequently asked questions, FAQs, as to here's what you should present as being valuable to the customer, and here's what you should say if they, say no or throw up a negative during the sales process. So I think in the first couple of years, direct sales efforts. From then on, you can engage partners. Is how I would suggest to do it. Another big, what type of company you are, what type of product you're going to offer, how are you going to sell it, all big items. Another one of the big items is who's going to do it. So if you're building your early stage company, and I'm going to guess, again, some of you are founders or entrepreneurs, you might have a 1, 2, 3, maybe 4 or 5 person company or entity right now. Most likely you're going to want to add to that, though. And employees are the means through which you get work done and accomplish things. Employees are also very expensive. Employees are also hard to manage. Employees also need space. Employees also need tools. So the type and how many company, or gosh, employees you're going to hire has a big impact on your cash needs. Really what I'm saying here is everything affects your cash. And now I am going to turn to the model real quick. So let's see, you're looking at my desktop. So we'll get rid of this reminder here for my class. And you should be able to see the model, I believe. I'm going to actually minimize the screen here. So you should be able to see the model, and you'll see the first tab in the model. And again, this is available. Allison is probably giving you a link somewhere where this is available. The first tab in this model, if you look, see it says notes where my cursor is. I've supplied a template of notes that you might have to serve as a guide or a, what do you call it, an index to your model. But what I say here is, again, these are notes to financial projections model. But what I say here is, please read this. This model is a template and contains hypothetical data to illustrate how formulas and integrations flow. But don't just accept my information. You, as the user, need to enter your own data and change, you know, the sample information that I've put in here. I've actually had a couple people contact me after classes before, and they've actually used the numbers that I have for their model. Please don't do that. All I'm doing is supplying a template. I'm not supplying your numbers. How would I know your business? So let's just look at a couple of the notes I have here. The first one says, under general notes, the statements summary and statements monthly tabs, which if you look at my cursor, see statements sum here, where my cursor is, and statements monthly. Those tabs contain detailed and also summarized monthly and also quarterly income statements, balance sheets, and cash flows for 2 years. I do have information for future years, but in a more summarized manner. So why don't we just go ahead and look at the statement summary tab. And I'm not going to spend a ton of the time in the model, but I wanted you to at least see this. And I'm hoping this comes through large enough. I realize many of you may be on a laptop and this is going to look pretty microscopic to you, but we'll try here. So if you look here, I have the company's name is Next Unicorn LLC. So kind of a cool name there. And the first section is the income statement, also known as the profit and loss. And if any of you are familiar with the income statement or the P&L, you always have a section for revenues, cost of goods sold or cost of service maybe, gross margin, which is what you retain from every dollar that you sell, operating expenses or in other words, departmental expenses, to get down to eventually a net income or loss, or a net profit or loss, if you will. Down the page and in the same column, if you look here, I've got Q1 2020 highlighted. You'll see I then have the balance sheet with assets and liabilities listed here. And then if we keep going down the same Q1 20 column, see that? You'll see I have the cash flow. So what I've got is all three financial statements all stacked on top of each other in one column for you. So it's a nice, neat kind of summarization of your model. So I've got the first 4 quarters of this current year, 2020. I've got, not the first 4, the only 4 quarters of 2020. I've got the 4 quarters of 2021. And then while I have other years out here to the right, you see where my cursor is going out here to the right. I've got other years, but they're not as in a summarized manner. So there I've got 2022, 2023, but I don't have them in as summarized of a manner. Let's look real quickly at the statements monthly tab. So now you're going to see I have the month of, or had the month of January 2020. So obviously, if you're going to use this model for the future, you'll want to enter, you know, the months and years that are relevant to you. I built this back several years ago and updated it to 2020. Obviously, we would now be in what? November 2020, but you'll need to change these dates to match your model, goes without saying. So this tab, the Statements Monthly tab, is just the monthly version of that Statements Summary tab. the statement summary tab is probably more presentable to put in a slide deck, whereas the statements monthly tab is a lot of detail, lots and lots of detail. I'll wear you out with detail, as a matter of fact. So let's keep going in the model for a little bit here. Revenues, pretty much the most important thing in the model, right? If you don't have revenues, you don't have a business. So what I'm going to show you here, and can everyone see this? Is there anyone that's having an issue? I'm assuming you can.
Let's see
So
it.
if we look at my tab here called revenues, you'll see at the very top, I say this is a named bookings and revenues forecast. Well, what's Phil saying there? Named means I'm actually going to go through, you're going to go through as you start building out your revenues, and hopefully you'll be able to name the first few prospective customers or prospects that you're going to approach or have already had some kind of conversation with. You're actually going to list those names right where my cursor is. You know, ABC Inc., Google, Apple, Hospital X, you know, just any customer that's relevant to your situation, you're actually going to enter their name here as having talked to them about purchasing one of your products or services. In the next column, I have products and services. So I actually have a drop-down menu. You can change these. And I have, for example, here, software generation 1 of our software product, generation 2 of our software product, generation 3, implementation fees, consulting fees. So I have an initial drop-down menu for you of your potential revenues. You'll want to change that, of course. I have a close date here. So in other words, let's say it's January 1st. I've actually projected on March 1st, I'm going to close a deal with customer 1, whatever their name is, for software, for our software, for the first generation of our software at March 1st for a price of $40,000. So I'm not going to get into this a lot right now. You can see I have a formula right there. What I've done on the next tab is actually try to build out profiles of customers over here. I don't know if this is going to fit your situation or not, but I tried to give you a little bit more of a revenue model here. I don't know if this is going to work for some of you, and if it doesn't, it doesn't, but at least I supplied it for you. So what you could do is just go in here and instead of referring to some deal here, you see where my cursor is, just simply type in here, hey, my first sale is going to be, I don't know, $22,000. Just type it in fresh. The next cell, and we're going to get off the model here pretty quick. The next cell I have, it's called a CEO toggle. And you're like, what on earth is Phil talking about? That CEO toggle is used to apply to every booking in this revenue tab, and it's used to run what if scenarios. So right now I have bookings, which, by the way, what's a booking? A booking is you have signed a customer to a contract or a deal. We booked a deal. So in company parlance, that's called a booking. A booking isn't necessarily revenue. A booking is you've signed a deal. Now, after that booking or that contract signature, you have to deliver the product or service. So a booking is great, but it's not revenue yet. So I'll describe that more in a second here. But what this CEO toggle is meant to do is this is a global a percentage, if you will, that I'm going to apply to all my bookings. You see, I'm painting this, all my bookings, and seeing what happens to my profit and loss if I change that percentage. So right now, all these bookings I have listed here, see my cursor, amounts to a first year booking total of $280,000. You see that? If I go change that, and I'm going to do easy math, if I go change that to, well, let's just see what happens if I do 50% of that. That number then for the year changes to 140,000. Or if I say, hey, I think me and the team are going to do 75%, I'll hit that. And I go and look, 210 is 75% of whatever number I had before. So it actually changes the results on the fly and changes your P&L on the fly. So that toggle cell right there is actually a pretty powerful cell. When investors look at your model, they're going to cut your revenue off. You often hear this. They're going to cut my revenue projections by 20% anyway. Well, here you can go ahead and test within your model and see what happens if you cut your revenues down to 90, 80, 72, 65% or whatever. So bookings on the revenue tab, bookings is the first section. Then if we scroll down a little bit, see I'm scrolling, we come to a revenue section. So again, bookings are signing the contract with the customer. You've booked a deal. Revenues are where you're going to map out where you're delivering the deal. And I'm not going to go into a lot more detail here because you can see I could chew up the hour doing that. But I wanted you to see the detail orientation of the model and how I hope it's going to be pretty flexible for your use. One more thing while we're in the model, and then I'm going to ask for questions, is employee input. So remember, we talked about the type of company is extremely important. How you're going to sell your product is extremely important. The revenues of your product or service are of paramount importance, but the people to deliver all that is right below revenues in importance. So if we look at the employee input tab, you see where my cursor is, input. This is kind of like the same theory, if you will, as the revenue tab, in that it's inputs in all of these green and blue cells. Oh, which I didn't really say that. In my model, cells that are in a blue text, and a green background are input cells. Anything that's in white, as you can see, is a formula. So input in the green cells, formulas in the white cells. So let's say you're starting out your company and you are the CEO and you're John Doe or whatever here. You're the CEO, there's your title. You've got some manager, whatever. You can select which department you're going to be in. You see, I've supplied you like what? I think I supplied you with about 10 departments, so you can change those names. You're going to have a start date. Of course, everyone has a start date. Hopefully no end dates. Your start date in this particular case, I just picked as January 1st. So, John Doe was hired as CEO on January 1st. You might be John Doe, by the way, on January 1st at a salary of $80,000. By the way, you might actually be working for zero for the first few months or year or two. When we co-founded our cybersecurity company, for the first year, we took zero in salary. Zero is pretty low. Let me tell you, zero is so low that you would actually pay to work at your own company. Think about that. But in the early days, when you don't have any cash, you don't have any product, you don't have any other team members, most likely you're going to be paid zero. If you haven't raised any money, how are you going to pay yourself? It's probably going to be zero. But let's say you're projecting for better times and you are going to have some money, and you've got your initial CEO and CTO already employed. But now we're going to hire a third person. Woohoo! We're going to increase our team by 50%, 3 on top of 2. So we're going to hire a third employee here. They're going to be a developer. We picked from our drop-down model. We're going to hire them March 1st, and we're going to hire them at 70 grand, let's hope. So you can see if I enter, let's go and enter, I don't know, May 1st, 5/1/20. See how the cursor see how the formula just changed here? It was in March, now it's in April, in May. And let's just say we're actually going to hire them at not $70,000 or $5,800 a month. We're going to hire them at, $55,000. So now that number has changed down to 1/12 of 55,000. So the point is, this tab allows you to map out all of your hires, their start dates, and their salaries. So the top section is employees. I then have a section down here below, if you can see my cursor, for contractors, because most likely when you start your company, you're going to probably engage contractors before you commit to legally hiring full-blown employees. In fact, I would suggest to do that. It's almost trying your employees before you buy them. Try them before you buy them. So I would suggest you actually do exercise and use this contractor section before just hiring all employees up here. And in this tab, I also have some summary sections down here, like salaries by department, contractor dollars by department, headcount by department, and so forth. So you can see, again, this model is pretty darn detailed. So are there any questions so far? I don't want to sit here and just monotone the whole time. Are there any questions so far? Okay, if not, I'm going to go on back to the slides, and you can see that, boy, that clock is racing. So let's keep moving here. Let's go back to here real quick. Let's go back to the animation. Okay, so we just kind of looked at this. When you're inputting your model, you need to do things in a modular fashion. One of the jokes I always make is when you form a company, let's say you're a founder and you have a couple of co-founders, so there's 3 of you. You guys in the beginning are very thrifty. In fact, when we started our cybersecurity company, I often joked, I said, everyone's BYOC, bring your own computer and bring your own phone and bring your own keyboard and bring your own everything, because there's no money to pay for it. So when you start out, everyone pretty much brings their own stuff. But you'll find as you start hiring past 10, 15, 20, 30, 50 employees, let's just say employees become more expectant. In other words, employee number 50 is probably not as entrepreneurially minded as employee number 3. I mean, that kind of makes sense. When people come into a building or an office and see 40 other people there, they just assume there's kind of a machine in place. So the company's going to kind of take care of things for them. When you're early on, there is no one to take care of it except you at your dining room table or at your, at your individual desk. But employees aren't going to be shy to ask for tools and tech. In fact, technologists love tools and tech. Believe me, I've been in enough companies to see it. So I often joke that, they're going to want, the most expensive, the most robust and powerful latest laptop, let's say. And by the way, I want a docking station so I can have a nice big monitor. And come to think of it, I really want 2 monitors because, I cover a lot of space. And plus I'm pretty important, by the way. I also want a chair that's very ergonomically, comfortable. So, I need one of those $1,000 chairs that you see out there. And also, I don't want just any desk. I want a desk that actually goes up and down. So a standing desk. And I don't want to have to crank it manually. I want one where I just push a button and it automatically goes up and down because, again, I'm important. I'm an employee. I'm important. And actually, if I really have to be honest, Mr. and Mrs. CEO, what I really want is a treadmill desk. So can you make sure you have all that ready for when I join? Because again, I'm an important employee hire here. So what you're going to have to learn is to tell your employees the word no, because they will probably not be shy in asking for things. And you're going to have to learn how to manage their expectations and manage cash. So I could go over a lot of other stuff here, but bottom line is employees will not be shy to ask for things. And what you've got to realize is that pretty much everything affects your initial and ongoing cash needs. And you're going to have to use that word no more than you would think. And to drive the point home, I often say, cash is not only king. A lot of people say cash is king. I say cash is not just king. Cash is King Kong, as I kind of hit the desk making my point. So out of cash, out of business. So again, keep your model modular. Look at what happens when you add revenues or modify revenues. Look what happens when you add a body or change the salaries or the timing, when you add benefits, when you purchase computers and so forth. Any of these changes, or in other words, anytime you make a change to any revenue or any cost, it's going to affect your cash, of course. We already looked at this particular slide. We saw it in the model, the hiring, the employee input tab. So again, we want to see what happens if you add any of these items. So I'm kind of going faster now. We've got 15 minutes, hard to believe. So there's three kind of financial statements, which I briefly went over in the model, if you remember. The income statement, also called the profit and loss, also called the P&L, the balance sheet, and the cash flow statement. Well, let's take a look at those. Those aren't so mysterious, right? An income statement is what you sell, the revenues. There's my cursor working, revenues. Cost of goods sold or cost of services performed gets you down to gross profit. What's gross profit? Gross profit or gross margin you can think of as how much of every dollar that I sell do I retain? Well, in this case, I retain 80%. That's pretty good, by the way. 80% is probably about as high as it's going to get. Again, I built this model in the form of a software company. So software companies usually do have pretty good margins, if you will. Then you'll see operating expenses. These are usually what are often referred to as departmental expenses too. What are we spending on technology, sales, marketing, and general administrative? That gets you down to operating income, also called EBITDA. We're going to look at that in a second. And eventually down to my income or loss. And a balance sheet, if you don't remember anything else I say today about the financial statements, just remember, very easy, don't be intimidated. Assets are what you own, O-W-N. Liabilities are what you owe, O-W-E. It's that simple. Asset, what I own, liability, what I owe. Then equity, shareholders' equity, is what I retain. So what I own minus what I owe is what I keep, or in other words, equity. That simple. The cash flow is a way, it's a statement to convert our income statement to cash. And let me show you how that works real quick. See what I just did? So you won't see this in an accounting class, which I don't know why they don't do it this way, because this would actually be very sensible. An income statement's profit or loss, see where my cursor is, $149,000 loss this year, actually gets taken to retained earnings, how much earnings or loss is retained in a company. And it also is the starting point, if you see where my cursor is, of the cash flow statement. So net profit or loss is the only number or figure, if you will, that is actually in all three financial statements. The cash flow in converting net profit or loss to cash also needs to match what your cash is on your balance sheet, where that makes sense. And then assets have to equal liabilities. After all, a balance sheet actually has to balance. Therefore, it's called a balance sheet. So assets ends up equaling precisely liabilities and liabilities and equity put together. So I'm going to skip that. I'm going to assume that you've been listening closely to all I've been saying and try to speed up a little bit here in our last bit. Some financial terms that I think you should know, and hopefully you do know, but if you don't, here they are. What's burn rate? You know, what an investor is going to say, well, what are you burning every month? And you're going to be like, geez, I guess I should have listened to Phil and actually paid attention to what he was saying. Burn rate is the trending amount of cash you consume in a given period. Usually you state it in terms of a month. So what's your monthly burn rate? Well, it's cost of goods sold or cost of services performed, your COGS, you'll hear it mentioned like that, your operating expenses, all the departmental expenses, all those people you're paying, all the rent, insurance, marketing expenses, all that, your capital expenditures. In my business, every truck we buy is a minimum 150 grand. How would you like to have my business? And when we buy trucks, we have to buy two at a time because remember, we're a convoy trucking company. So every time we add a truck, we really have to add two, which means I'm writing a check for $300,000 every time we buy a new truck or pair of trucks. We're a capital intensive business. You probably won't be. So it's COGS, cost of goods sold, operating expenses, capital expenditures, and any debt obligations you might have, which you probably wouldn't have debt in the beginning. But all those comprise your monthly burn rate. Remember that. What's cash runway? What on earth is that? Well, cash runway is simply the amount of cash you have on hand now divided by that burn rate. So easy example. Right now, we've raised some money, did our seed round and stuff. We've got $1.2 million in the bank. So $1,200,000. Woohoo! You're burning $100,000 a month. What your runway would be is $1.2 million. That's how much cash we have, divided by the burn rate of $100,000. That means I have 12 months of cash left. Well, that's not really long. What if we take our burn rate down to $50,000? Well, in that case, it's going to be 24 months of runway. $1.2 million divided by 50,000 being burned a month equals 24 months or 2 years of runway. So you can see how you can kind of just become familiar with or fluent in these terms, and you'll need to know these terms when you're talking to investors. EBITDA, what's EBITDA? EBITDA is earnings, it stands for earnings before interest, taxes, depreciation, and amortization. It's also called operating income, because what financial professionals would say is interest on loans isn't part of a normal operation. That's not part of operations. Taxes is sure not part of our operations. That's relegated to us by governmental bodies. Depreciation is the ratable expensing of assets that you've already purchased in prior periods, so that's not part of your current operations. And amortization is the expensing of intangibles that you've previously purchased. So really, earnings before all those items is how you really performed this month, or what you earned or lost from operations. EBITDA is one of the most important terms to know when talking to an investor. In fact, I would really say EBITDA and burn rate, you got to know those two, hand down, know it when you're asked, be able to answer it in 2 seconds. Break even. Well, what's break even? It's simply when you reach the point of cash flow break even. You're bringing in more money than you're expending. So what you're bringing in is more than what you're paying out. And you usually measure that in about 3 months or a quarter at a time, because you'll find over your early months, you might be cash flow break even 1 month and not the next, and you are the next and not the next. So it's usually when you've obtained that or achieved it for 3 months in a row is when you've achieved break even. You'll certainly burn cash before you sell it. So what I'm going to do here at 122 is just simply summarize by saying you won't build the perfect model the first time. You won't even do it the second or third or fourth time. But the point is, when you've got a model that's well constructed and you've listed your assumptions and you've built it in a modular format, or use my model, which I think can get you probably 2/3 of the way where you need to go, then you'll have something that can stand up to the scrutiny and review of investors. You don't want to send the model to investors and have them point out mistakes. That ain't cool. So what you need to do is not just do a test run, do multiple test runs, perform what if scenarios like I showed you on the revenue tab, remember? And see what happens to the model and how it behaves. If you reduce revenues, most likely your profits are going to come down. If you reduce revenues and you see your profits going up, you've got a formulaic error somewhere. So what you want to do is, again, stress test your model before you share it with others. So what I'm going to do with 6 minutes left now, it goes really quick, is I'm going to flip over. And so I hope you use that model. If you've got questions on it, let me know. It's been used by, I'm actually probably going to say a couple hundred CMU students in the past. So I think it's been used quite a bit. I'm going to flip over to the cap table here real quick. Are people still engaged and still here? Any questions? So I'll just assume so and keep going. So let's look at the cap table. It's a real interesting part. It's the last 5 minutes we're going to spend here. And here it is. I'm going to close everything else. I'm going to make this big for us here. And here's the cap table. So can you see that? So what I'm going to do is make this even bigger for you. Now it's really big, 130%. So let's say in the very beginning, if you look at my cursor, we have got, let's just say there's 2 founders. Let's make it easy. And each of you have $1 million shares. By the way, there's no magic as to how many shares or units if you're an LLC. When you're an LLC, you actually have what are called membership units. They aren't shares, they're called membership units. That's an LLC. A corporation or a C Corp has stock, so it has shares of stock. We're just gonna say shares of stock for simplicity here. So you two co-founders have 1 million shares apiece. So you can see 2 founders times 1 million shares apiece is 2 million shares to start out with. There's no magic as to how many the number of shares you have starting a company. Usually it's commonplace to have 10 million shares issued for a new entity, a new company, or 10 million units for a new LLC. You could really actually have 1 share issued and just everyone would own 0.001 of a share or something like that. But that sounds kind of silly. So 10 million is kind of the norm, not necessary though. So in this case, 2 founders having 1 million apiece, 2 million shares. Well, let's just say you're going to add some management members. Let's say you hire 2 management members. One of them costs you 300,000 shares of equity, the other one 200,000. So 300 and 200 is 500,000 shares. So where you guys used to own, remember, I'll go back, 100% of the stock before you brought in anyone else or any investing, you now own what? Only 80%. 2 million divided by 2,000,005 is 80%. So, my ownership percent has gone down. One thing you have to pay attention to is it's not the number of shares you have, dummy. It's the percentage that you own. Shares are just a number. They can be anywhere from 0.000001 to a billion. It's a number. What matters is the percent. A pie has precisely 100.0%. It will never have more. It will never have less. It will be 100% every day of your business. So percentage is what you need to pay attention to. How much percent are you giving away? How much percent are you selling? How much percent are you granting to others? And most importantly, how much of a percent are you keeping for yourself? Because after all, you're the founder. So we've awarded $500,000 to some other management members. Now we've sold a little bit of stock to friends and family for about 100,000 shares. So now all of a sudden we're down to 77% and so forth. So we actually, created what's called an employee option pool. Bottom line is you're now only a 2/3% owner of the company. You're no longer 100%. So now you've got your initial funding picture, if you will, of you've hired your initial team, you've taken in just a little bit of money from family and friends. You've got an employee option pool, which you can use to, grant shares out of over time. You've got 3 million shares outstanding. You own 2 million as the founders, so you own 2/3 or 67%. Now enters outside investors. Now your world's going to change. Now your world's going to be rocked. And in this example, what I've done here is, here's where I'm trying to break down the complexity of a cap table for you. Anything in blue is negotiable and an input. Anything in white is a formula. So the number of shares you have is fixed. It's tied to that cell where my cursor is. It's however many shares you have coming into a round of funding, in this case, 3 million. The value of shares is simply, click on it here, the valuation of the company divided by the number of shares, or values divided by shares. In this case, I've just assumed a company valuation of $2 million before investors come in. How did I come up with that? In later stage companies, it can be considered somewhat scientific and according to formulas. In an early stage company or a brand new startup, that number is negotiable. That's why I have the word negotiated right there. It's not so unbelievable to have an early stage company valued at least $1 million. A lot of times you'll just kind of get a free pass on that much. But when you start going up to 2.5, 3, 4, 5, 6 million, I mean, you've seen Shark Tank. Sometimes investors or entrepreneurs come in with a lofty valuation only to get shot down by the sharks, right? Well, that's actually kind of what's going to come into play when you're dealing with investors. They're going to try to depress your valuation. You're going to try to amp up the volume of your valuation. So that is a negotiable item there. I realize some of you may be cutting out now. I'm going to go on for, let's say, 5 more minutes, if that's okay, just to finish this off. Is that okay, Allison?
Yeah, that's fine.
Okay, and whoever drops off, but we'll give it 5 more minutes, and I have to respect everyone's time. So in the beginning, Phil, you, Mr. and Mrs. Co-founder, have decided that the company is worth $2 million. By God, we're going to stick to that. So the company is worth, the shares are worth 67 cents a piece. 2 million divided by 3 million outstanding equals 67 cents a piece. I'm now going to raise some money. Well, what you're going to do is use the model that I supplied you, or your own model, and determine how much money you need to raise to last your operations at least 12 months. So in your first fundraise, you should be raising enough money to last at least the first 12 months. So that's why your model is going to become important, because you're now going to enter that figure plus some cushion here. So the model plays into this. What you really ideally would want to do is maybe have that first round last for 15 to 18 months, but let's just say it's 12, whatever. So what I figured out from my model, blah, 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 is I need to raise $500,000 here. So there's kind of give and take. I want to raise enough to last me that supposed year, but I don't want to raise so much that I'm diluting myself at this low initial valuation of 2 million, because by God, I think I'm actually a $4 million company now, but I'm just trying to raise some money. You know, the investors are beating me down, so I'm going to settle at $2 million, but for that lower valuation, I'm only going to take in $500,000. So let's see through the math, through the formulas, what that did to me. So if we look at post-seed, I'm calling this a seed round. If we look at post-seed, wow, my 67% ownership just became 53% ownership. Eeks. So yeah, when you bring in new money, that costs you shares and that costs you equity. So you see, it's all about the percentages. This $500,000 round on top of a $2 million valuation ended up costing me 750,000 shares. That's $500,000 in the money I just talked about bringing in, divided by 0.67, which is the price per share, equals 750,000 shares. So you see where that 750,000 in new shares became shares on my post-seed cap table. See where that works? And that cost me 20% of my company, or in other words, this math right here, $750,000 divided by the initial shares of 3 million plus the 750,000 shares equals 20%. So my 3 million in total shares before the round became 3.75 million shares after. Well, let's just say we're able to, you just really fought and battled with the investors, and you were able to get a $3 million money valuation. So 3 million. Ooh, now I'm only giving up 14.3% of my company for that $500,000. So you can see this pre-money valuation has a big impact on the eventual number of shares and percent of shares I'm selling, and allows me to keep more than the 53% I just showed you when the valuation was 2 million. Well, let's just say, well, in exchange for a higher valuation, the new investors now want to give us more money. Remember on Shark Tank, you'll hear, Mark Cuban say, well, I think you need more money. So they're going to give you more money, $750,000. And now that $750,000, geez, we're back to 20%. So you see how you just start playing with these two figures. Pre-money valuation is negotiable. The amount of money you're bringing in is negotiable. Everything else is just the math dummy. It's just formulas. So I hope that this has helped to at least give you kind of a cheat sheet for a cap table. This is just a really simple thing. If you can just insert two numbers, you can do the math. It's that easy. So this has been supplied on the website for you as well. So I know that that was all very quick. I went through that much quicker than I would like to, but I hope that this has added value, and I'll take any questions for those that are remaining right now. Thank you very much.
Do we have any questions?
Where will the Excel documents be found?
I'll answer that. So it's on our Connects website, and under Phil's talk, I'll have that on there, and then it's also on our archives page, and I'll put a link in the chat now.
Thank you.
Mm-hmm.
Yeah, and like I said, this is a time when often students come up afterwards. It's weird, it's 2020, we can't do that. But if you do have a question, feel free to reach out. I'm happy to try to answer some questions. So any other questions? Okay.
Okay. All right. Well, thank you, Phil, and I'm going to